In this week's video, we'll examine the charts and the hard evidence to help us answer the question, is the stock rally just getting started? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We're going to jump right into price this week since it's the most important thing. This is a daily chart of the S&P 500 index as of a close on Friday, October 23rd. Point of the exercise. Obviously, we have a bullish breakout here, but it's important to understand what happened in the days leading up to this breakout. If you follow along on Twitter, you may remember a tweet late Wednesday afternoon after the market closed that said, sometimes when you look at the charts and you say to yourself, there is no way the S&P 500 will have a green day tomorrow, we get a green day. This is the S&P 500 index as of a close on Wednesday, October 21st. This is the downward sloping trend line that everyone has been watching. This defines the current downtrend. We came up to a reasonable area here, a logical area for a reversal, and intraday we were rejected. If you can see this up close, we closed right here. That is an ugly looking close. Rejected, 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 rejected near all of those levels, and then coming back down and giving back this breakout. It's important to note that this session here, where we gave all that back, occurred on 99 million shares for SPY. The average day is 148 million looking back 3 months. So this is relatively light volume. Let's fast forward to the next day. After having that no way will the S&P 500 be up on Thursday look, on Wednesday afternoon, Thursday was up 33 points. Notice the close here, all of that is reversed, and everything that we were unable to clear on the prior day, on Wednesday, was cleared on Thursday. And this is a significant breakout here because this is the downtrend that's governing price. Also note, the conviction on this day to buy is much greater than the conviction to sell in terms of volume. This move here occurred on 99 million shares. This move here occurred on above average volume, almost 165 million shares, which is well above average and significantly higher than the conviction to sell. What did Friday look like? If you've been using charts for years in the markets, you know that sometimes you break a trend line only to give it back the next day. That's not what we had on Friday. In fact, on Friday we had a bullish gap up. And as many people know, gaps are often revisited intraday. We did not revisit the gap. Also notice on this trading day, volume again on Friday was strong. It came in at 144 million shares roughly, well above the desire to sell at 99 million on Wednesday intra-week. Also notice, relative to the October 2nd reversal, this was an extremely high volume day as well. Only October 8th and the prior day, October 22nd, were higher since the low. So these 2 days, we have very significant moves at a significant level on very impressive volume. Before we switch gears to the NASDAQ, this is the important trend line that we were just looking at from a little bit further out in terms of perspective. Now we're looking at a daily chart of the NASDAQ as of the close on Friday, October 23rd. On Thursday evening, we had some positive earnings from some tech bellwethers. We didn't break the downward sloping trend line in the tech-heavy NASDAQ until Friday. We gapped, huge gap here. Think about the importance of this trend line and how many people are watching it. And think about the importance of the 50-day and the 200-day. Notice the 200-day has been flat and it's turning up. This is a positive slope here, and price is above a 50-day that is also trying to turn up. A legitimate question may be, Chris, that's an ugly looking candlestick. It's indecisive. I would agree with that. It is a concern. So let's talk a little bit about what this might be. It is possible that this is what's known as a runaway gap. The last two sessions occurred on stronger volume relative to what we've seen recently, especially on Friday, this potential runaway gap that we have here. The average volume for the triple Qs is 40 million shares per day. On Friday, according to Yahoo Finance, it traded 53 million, which is the strongest volume day since the important October 2nd intraday reversal. This is a good sign. Wednesday was a down day, and look how low the volume was. On a down day, 29 million. An up day, 40 million. On an up day, 53 million at an extremely important area. This text here comes directly from stockcharts.com. We've blown it up here so we can review it. Runaway gaps are also called measuring gaps and are best described as gaps that are caused by an increased interest in the stock, or in this case, an index. For runaway gaps to the upside, it usually represents traders who did not get in during the initial move of the uptrend, and while waiting for retracement, decided it was not going to happen. Translation: if this is a runaway gap, this gap and spike in volume could be caused by people that didn't buy the low and were waiting to see what would happen at these trend lines. Again, from stock charts, increased buying interest happens all of a sudden and price gaps above the previous day's close. This type of runaway gap represents an almost panic state in traders. And if you were following the markets the past 2 days, it did feel like a little bit of a panic. Also, a good uptrend can have runaway gaps caused by significant news events that cause new interest in the stock, or in this case, an index. In the chart below, note the significant increase in volume during and after the runaway gap. We already noted that we had better volume here and very, very strong volume here. Is this a runaway gap? We don't know that. It's a pure hypothesis. Price has to confirm it. What about the candlestick? This is the example that Stock Charts was referring to in their great educational section on their site. Ford Motor Company, 2003. We have a downtrend, a retest of the low here, and notice a very, very strong looking candlestick here. This would be similar possibly to the October 2nd intraday reversal. We're approaching an important point here, the 50-day, and we have a downward sloping trend line. Off of that, we get a big, huge gap up. And if we zoom in on this, this really is not a confidence-inspiring candlestick. It is similar to the candlestick that we saw in the NASDAQ or the triple Qs on Friday, which has somewhat of a doji or indecisive look. This is the high of the day, this is the low of the day, and this is the close right in the middle. In this case, what happened next? Ford Motor Company never retested this gap here. It recaptured the 200-day. We had a nice cross here. And the most important thing is, from this point here to this intraday high here in this example, forward after the runaway gap that was confirmed by price. We need to see that in the present day. Ford gained 189% from this point where the cursor is to this intraday high here. Does any of this mean that that is what we will see in 2015? Absolutely, positively, no. And we also understand that 2015 is different than 2003. That argument can be made about any historical market reference. We are just studying chart formations to better understand probabilities. Nothing more, nothing less. Price would need to confirm the potential for runaway gaps from Friday's session. Remember last week on October 16th, we talked about this breakout here from the trend channel after the waterfall plunge. So this is the breakout last Friday. These are the 1, 2, 3, 4, 5 trading sessions that we just had this week, and this is the scare and the horrible look. Last week we also talked about the potential broader implications of this lower trend channel. This is the lower trend channel that we just looked at. This is the upper trend channel that we talked about last week, and here's the breakout from the lower trend channel last Friday. This is October 16th. But we also noted that we had numerous forms of potential resistance overhead. Let's fast forward a week. This is the same chart as of the close on Friday, October 23rd. We've cleared these obstacles here, and we've clearly moved into the upper trend channel, telling us that the potential to push above 2130 is better today than it was last week. Bottom of the trend channel, top, bottom, top. If we went back to the top, we would push above 2130. Not a prediction, it just speaks to probabilities. I know everybody's getting tired of looking at these bullet points from October 2nd, but bear with me. The evidence builds on itself over time. On October 2nd, we had reason to believe that a significant intraday and intra-week reversal could be taking place. Since then, we had a 63-point gain, an 18-point gain, and a 42-point weekly gain in the last 5 sessions. That tells us that the market, for the most part, has confirmed these bullet points and they remain in play. Did we get any bullish evidence the next week? Yes, in the following week, on October 9th, we covered the breadth thrust, and the key point was most important lows are marked by a sharp surge in breadth. We had it. We also said that it was possible that the legitimate concern with overhead supply in 2015 didn't necessarily mean that the market could not move back into the consolidation area. We've done that. We've moved below these levels in 2015, and volume has told us that the bias has been to buy near these levels so far and not to sell. That can change at any time, but the evidence right now is pointing to overhead supply might be overcome. And if it's not overcome right away, the odds are still pointing to overcoming overhead supply in the weeks and months ahead. Did we get some positive feedback from a bullish perspective in the following week? Yes, last week we covered the bullish TDST breakout on the daily S&P 500 chart. All of this tells us that the conditions are in place to believe that we could have seen runaway gaps on Friday. That's not a prediction at all, but as the evidence builds on itself, it wouldn't be shocking if those were runaway gaps. Only time will tell. 2 quick points here. These are levels that we wanted to clear. Notice the strong conviction in the candlesticks on Thursday and Friday of this week. This is the candlestick on October 23rd. daily RSI, which helped us with a bullish divergence down here. RSI is now at the highest level that it's been, I believe, in the entire calendar year. At a minimum, we have exceeded these levels here, and it's the highest level for daily RSI that we've seen at a minimum since the springtime. Also, we are not in overbought territory yet, so this reading doesn't necessarily say that we don't have some room to run from a probability perspective. We covered this chart in detail last week. You can look at last week's video. The takeaway here is we've cleared these levels, and now the probability of this being a counter trend rally within the context of an ongoing downtrend is quite a bit lower than it was here. This is an S&P 500 chart from a week ago. This is October 16th. Point of the exercise. We had this level here as possible resistance, and this level here as possible resistance, and this downward sloping trend line as possible resistance. If we were just looking at this chart in isolation a week later on Friday, October 23rd, it's pretty easy to say that it looks better than it did a week ago. Also notice we cleared all of these levels that we just talked about on very, very impressive volume. All of this just speaks to improving probabilities, doesn't throw out any scenario about lower lows. The odds of lower lows are just getting smaller and smaller. They're not zero. Same thing here. We're looking at the high to low fibs. This is what we covered last week on Friday, October 16th. This fib is unquestionably potential resistance. How does the same chart look today? The answer is we cleared potential resistance, telling us something about bullish conviction relative to bearish conviction. Continuing with the case that the evidence builds on itself. This is our double bottom, or our W formation that we showed on Twitter after this bullish breakout here. We have a bullish breakout, a successful retest, followed by a higher high. All of this leans bullish. Regular viewers and clients know this chart. We closed above this important level for the third week in a row. The longer we stay above it, the higher the probability that the bullish fractal analysis might come back into play. But that's premature, and we also have a trend line here that we'll be keeping an eye on. Remember, when we were in be patient mode, we showed on Twitter several times that the S&P 500 was below the daily, weekly, and monthly pivots. On Friday, October 23rd, we closed above both of the pivots and cleared this resistance level here. On Friday, October 23rd, we now have 2 weeks in a row that we've closed above these weekly pivots, which looks different than this period here. We've also moved back above the monthly pivots, which is different than the prior 2 months. This chart needs to close above the pivots, but what all of this tells us is that the probability of good things happening is now improved on a daily time frame, a weekly time frame, and a monthly time frame, all of which speaks to improving probabilities of good things happening relative to the probability of bad things happening. The last 2 sentences about probabilities also apply here. We've covered this. We have our 3rd consecutive week of closing over the 100 week, which looks quite a bit different than this period in 2007 and 2008. We still have several trading days left in the month, but this also leans bullish. We're now back above these key levels that we've covered before. We've covered this chart in detail in these videos in past weeks and also on See It Market. We did not want, from a bullish perspective, the VIX to recapture 2228. This week it closed at 1446. If you've been scratching your head wondering What in the name of God is going on in the stock market? This is one of the explanations. There are numerous reasons. Recently, the expectation for the markets was that the Fed and other central banks over time would gradually be stair-stepping up on rates. It's a significant shift, signaling possibly the end of an era of easy money. So the first rate hike doesn't mean much, but the market knows that liftoff tends to be followed by numerous rate hikes. And the market understands that we probably would not have seen numerous rate hikes right away, but typically that's what happens. And once they raise rates once, they definitely would have a bias to try to raise them again rather than lower them. So this was the prior expectation to move to a world where liquidity was less friendly to the economy and less friendly to the financial markets and asset prices. On October 2nd, when the bad employment report hit the wires, market participants started to realize that this expectation of a gradual end to the era of easy money might be a little bit premature. So instead of rates ratcheting up potentially over time, the data became so weak across the globe that there was a significant shift where now, instead of going above the baseline, it was possible that central banks would be pushing out the implementation of these policies, and they might even become more accommodative over time. So negative interest rates or more QE. This is one of many reasons why the stock market shifted. Are there concerns as we head into next week? Yes, there are some short-term concerns. We have some trend lines that could come into play. And market breadth on Friday was noticeably weaker on the NYSE than it was in the prior day. It wasn't a disaster, but there was some selling going on. So what about market breadth? This is a historical example. This is a September to an August. We've removed the years to protect the innocent. If at this stage right here, when market breadth started to deteriorate, I decided to cut back or not buy based on that alone, how would that have worked out? Then we came down here. Did things get better? No, in fact, market breadth became even weaker. So notice it starts to weaken in May. It's weak for a full year to a May, and then for a second year to a May. 2 full years of potential yellow flags waving in market breadth. Is this important? It is important. Is it a showstopper? History would answer that showstopper question with a definitive and emphatic no. How can we say that? Well, during this period, for 2 years where market breadth was noticeably weak and concerning, the S&P 500 moved from the peak at 1100 to over 1550. During this period of market breadth, in terms of weakening breadth, the S&P 500 gained 41%. It's important, but in our book, it's not a showstopper. The market model does use market breadth. It just doesn't carry a heavy weight. And in fact, market breadth, this is the S&P 500 here, the indicator that we just looked at has been improving right along with the stock market since the October 2nd low. Just to keep regular viewers and clients up to date, these are some of the weekly charts used by the market model. This is what a low probability look looks like. This is a higher probability look. In the present day, we've moved from a clear low probability look in July to an improved look. We also have weekly indicators that are improving, and they are also tracked by the model. The model tracks 18 charts similar to this one, some of them risk-on, risk-off ratios, some of them indexes. Of the 18, 16 of the 18 have a full-bore bullish look, and I haven't looked at the chart since the close. It's possible it's 18 out of 18, but the 17th and 18th, those charts are very, very close as well. So the weight of the evidence is turning in a similar manner to price in the S&P 500. It doesn't tell us anything about the future other than the probability of good things happening has improved relative to the probability of bad things happening. Regular viewers and clients know that when we get these tight looks to moving averages, the tighter they are, the higher the probability of a big move in either direction. They're tighter here in 2009, and you get a big move in this direction. Remember, we broke to the upper part of that trend channel on the daily chart, and we have the potential for runaway gaps after breaking trend lines. This weekly chart is also starting to get that tighter look, with price now above all of the moving averages and the slopes are up. From a keep an open mind perspective, this chart has work to do, and it tells us that there's still repair needed to longer term trends, which always leaves the door open to counter trend rallies even if a low is in. And counter trend rallies can last days and they can last weeks. So it's important to keep an open mind when we head into trading on Monday. You can pause your video player and study this in more detail. This is a head-to-head comparison using the same time frame, 2008, the peaking process in October of 2007 into 2008. Red is the 200-day, blue is the 50-day. This shows 156 calendar days from the peak, which is where we are today. So how does this chart compare in 2015, 156 days from the peak? The answer is much, much better. On Friday, we closed above a 200-day moving average that now has a positive slope again. Our 50-day is trying to turn back up, and price is back above both of them. Here, you can see the slopes of both of them are down. Still have work to do here, but it's a much, much better look than the white space that we have between price and the 200-day here. It's been a frustrating period for many investors, traders, money managers, and clients. The moral of the story is if we continue to execute well and faithfully, eventually, when you buy one of these high probability looks or start scaling in, a look like this morphs into a look like this, and typically multiple week or multiple month rallies can follow. We'll head into next week with a flexible, unbiased, and open mind. As always, the charts, the indicators, the market model, and the hard data will guide us if we're willing to listen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.